Welcome back to Let's Talk Tax. I'm Dave McGuire. In today's episode, we're going to talk a little bit more in depth about OB3, OBBBA, and the effect it has on depreciation. Joining me today is Mike Hammel. Thank you for joining us, Mike.
Oh, appreciate it, Dave. Glad to be here.
So, Mike, I know a lot of things changed under the OB3. I know we got big 100% bonus depreciation. We got this qualified production property and everything else. As you're going out and you're talking to businesses, are you seeing that this is making a difference in how they approach not just acquisitions, but just how they approach their tax planning moving forward?
Great question, Dave. Yeah, I mean, we've seen a lot of movement with the OB3, and I think the biggest piece right now is that binding contract piece within bonus depreciation. You know, and what we mean when we say binding contract right now is you had a building that might have started construction, say, 2023, 2024, and stretched into 25, and it's kind of sprinkled out a little bit more, and it kind of had some lags throughout the construction process because we all know construction does not go as planned. And so you had some of these taxpayers that thought bonus depreciation was going to be at 100% on a building such as that, and it didn't turn out to be the case because there were some of these rules around the January 20th timeframe of 2026 that if you had more than 10% of your building completed, then you would fall under these new rules. Whereas if you didn't, you kind of fell under the old rules, which was at 40%. And so you look at a taxpayer on a building, you know, that's a big difference. If you're expecting 100% bonus eligible, but you only come in at 40 based on a timeline of a building.
Because the new rules, and you can correct me if I'm wrong here, it's not just based on placed in service, it's based on the date the asset's acquired as well as placed in service. So that's where that construction and that timeline comes into play?
Correct.
Is that something that is new to the OB3, or has this occurred other times with these binding contract rules?
So binding contract, we kind of, I would say, had a precursor to it with the Tax Cuts and Jobs Act. So when that was passed back in 2017 under Trump, that was one of those deals that had the exact same situation where we had to look into the contracts to know exactly how much was completed. And so we received regulations recently on some of these changes around bonus depreciation and the binding contract piece, but we were advising clients, advising business owners based on the experience back to the Tax Cuts and Jobs Act, just to kind of level and make sure that people are understanding that we're not going into this building and our tax planning for the year expecting 100%, but you know in some situations that everybody sees the one big beautiful bill, sees it's at 100%, and immediately their reaction is, hey, look, I'm going to be able to write off a lot more than I anticipated. But then it opens up the conversation working with our CPA firms of saying, look, we need to like temper expectations here because we're not going to be able to get 100% when you dig into invoices and figuring out exactly how much was completed on a building.
Now, so with the OB3, we get the 100% bonus. I know with the TCJA, we had a temporary and then it kind of leveraged down. How does that kind of transition in the next few years? Is it permanent? Is it something that we've got to worry about the leveraging down? How do we go about planning for kind of future casting, and what are you seeing with the CPA firms you're dealing with?
Yeah, so but really with the bonus depreciation is it's permanent. So we're stuck at 100% right now moving forward, whether that be an acquisition, new build. So I would say from timeline perspective, when you look into whether I'm going to buy a building or build a building and I have to push construction up potentially if that's possible because I'm running into a split year right at year end where, you know, under the Tax Cuts and Jobs Act, it levered down by 20%. That's a big number too when you start looking at that delta. And so from a planning perspective, it's a little bit more clear from a business owner perspective of knowing exactly what bonus depreciation looks like planning forward. We had these transitional years that we talked a little bit already with the binding contract piece. We don't foresee a lot of that happening more and more when you start looking at some of these buildings that we're getting further into a timeline, whether that be later in 26 or into 27. So there's some certainty around planning and knowing exactly kind of where the depreciation buckets might fall, because 100% will be around permanently until you know how tax law is. So we'll see if there's the election changes potentially, but as of now, 100% bonus.
So maybe actually we take a step back a little bit, because we talked about this 100% bonus. Where is bonus? Does bonus mean I'm writing off my full building? What does kind of bonus mean? Where are the assets within bonus, and how does that relate to the cost seg practice that you work with?
Yeah, so a couple things. Commercial buildings are depreciated over 39 years, residential over 27 and a half. Both are going to be eligible for bonus depreciation. And so there's lives of 15-year land improvement. So think of anything on the outside of a building. You look at, parking lots, curbing, landscaping, that type of piece is always going to have a 15-year life when you start looking at a construction of a building or whether that be an acquisition. Then you have 7 or 5-year life on the inside of a space. And so anything that is personal property, which would be categorized in that 15 or 7 or 5-year bucket, has the ability to be written off with bonus depreciation. So if you look at buying a $1 million building, if we can carve out, say, 20% into personal property and at 100% bonus, you're looking at about a $200,000 deduction in year one. Say 30% tax rate, you're looking at about $60,000 of actual tax savings when you look at doing a cost segregation study.
So that could be a big number for some people, especially, you mentioned $100 million or $1 million building, 20% of it, writing that off, 30% tax rate. That's 6% of your building costs coming back to you in tax savings in year one.
And then think about it on the flip side. If you're expecting 100% on a building that now, if we look at binding contract and it's a new build and it should be under the old rules at 40%, that's a 60% difference in a deduction that you would be able to take.
Wow, those are big numbers. Now, you mentioned something else, and I wanted to dive into it. You mentioned kind of this isn't just on new construction. I can do this on purchases, renovations, other things. Are there types of buildings where I might see more? Let's say I want a new office for McGuire Sponsel, and I got an option of building from the ground up, buying a building that's turnkey, or buying a building and renovating. Is it all going to end up about the same in the wash, or are there certain ways I could play that to maybe make some more?
If you're looking at maximizing depreciation, I would sit here and say, I think it always depends on pace at which the business owner needs the building. That's number one, just a business reason behind it. But new construction and purchases, you're going to get mainly around the same percentage points. There could be some changes based on the asset and what you're building it for, rising cost, various change orders that might go through it. But there's more value in a situation that the third one that you talked about. Buy a building and then have some renovations around it, and here's why. So you say we buy a building and you have value all the assets at the time of purchase, and say you guys occupy the space for a year, 2 years, and eventually down the road you want to renovate and you want to gut the spaces, build out new offices in certain areas, rearrange maybe the conference room, whatever that might be. Well, if we're touching the interior of a building, we could do a cost seg study on the purchase. So we're valuing assets. We're getting bonus depreciation. Let's say we're at 100% because we're within this timeline of 100% bonus out of the OB3. Well, then we wait a year or two. We do a renovation. We have this thing called qualified improvement property, which is the ability to write off and use QIP as a 15-year asset for any interior renovations. And so you go build those spaces out. You have a benefit on the initial purchase, but you also have a benefit, say 2-3 years out when you complete the renovation to be QIP eligible. So you're able to take bonus depreciation on both of those.
Wow, so that could add up quickly, and that's a good way to think of it, Mike. Now, I really appreciate one thing you said, and it's something that I've seen that sometimes people don't do, is you kind of re-emphasized that it's more about the business sense than it is about the tax. Don't let the tax tail wag the dog. I know I often tell people, I kind of let them know it's easiest way to not pay taxes is to not make money. So don't let the tax kind of drive the decision making. Let the business. Now, talked about bonus depreciation a little bit. I know there was something else, this qualified production property, or QPP, that's in this new bill. Can you tell me a little bit about what QPP is and where that comes into play, and does it relate to cost seg studies at all?
Yeah, it's a great question and a very, very hot topic right now. And so qualified production property, when you kind of simplify it, you gear it into industries such as manufacturing. So it's really manufacturing. And what this is really, if you remember back to when we had qualified leasehold improvements, qualified restaurant property, qualified retail property, all of these subsets of how we categorized some of those areas, such as QIP that we just talked about earlier. But when you look at some of those situations, you still do a cost segregation study. Okay, qualified production property, if you read a lot about it, people are pushing that you can write off the entirety of a building. Okay, I go build a $10 million manufacturing building, I get a $10 million deduction. As a business owner, if someone is trying to push that, obviously you're going to look into it, especially with manufacturing and how there's so much a push to have manufacturing back here in the United States. So the OB3 is incentivizing that with this subset of qualified production property. Well, when you look at doing a cost seg study, we're still going to value all of the 15-year components, the 7 and 5-year components in a space, but there's still items that are stuck in 39-year property that are still real property that might be devoted towards a lab, production space, maybe you say a testing space. Well, qualified production property is the ability to take that real property and write it off as well. And so it could be bonus eligible for those components of the building. So if I go back on an example, let's just say it's a $10 million new build, we find a $2 million deduction regularly through a cost segregation study, and there's $8 million sitting back in real property. Let's just say there's $4 million of that is QPP eligible and able to be written off. Well, we just found another $4 million of a deduction to that taxpayer because they're devoted towards manufacturing.
So that can really supercharge the benefits people are seeing in the first year or so on those deductions.
But the emphasis is still on you need a study to value that.
And I think, just to confirm, you said it's only the manufacturing portions of the building. It's not the office or anything else. Is that correct?
Yeah, that's correct. So no like warehousing, logistics on the back, distribution. You really need to be having some element to the manufacturing process, building out a product, a process, whatever that situation might be. So you think of QC, you think of the lab work, you think of, there could be some office spaces with engineer groups that are going in there and working through maybe prototyping and design work. It has to be devoted towards manufacturing. And this is where it was really great with a lot of our CPA firm relationships, because people were always trying to be the first to the punch to push out new information. And so as a business owner, again, if someone's sitting there and they say, hey, I can write off my entire building in year one, well, I'm going to entertain this. And so now you're seeing a lot. We've seen it trickling down to developers pushing more towards industrial buildings and such as that to then build out manufacturing spaces, because people are going to invest in those because the tax incentives right now are so lofty towards manufacturing.
Now, when you're out there, you said that they're getting a lot of these questions. So is this something where they're finding it that it's fitting more people than it used to, or is it really as restrictive as people first thought, or now we're finding out with the regulations that it's actually going to be every CPA firm is going to have one or two clients?
I think it's the last. I think there was a timeline there where, regulations weren't out. We knew that for a long time. So you're trying to advise and navigate that situation so that way you're not telling clients, hey, look, just wait, right? We'll be in touch. Well, and the reality is some people really want an answer, and we can give them an answer, but we can't give them a definitive answer. And so a lot of people, it doesn't matter what kind of CPA firm you are, whether you're a small local firm in an area or you're a large regional national firm, they're going to have clients that are renovating, expanding, buying, and building something devoted towards manufacturing. And so we've had a lot of those conversations recently just because people, like I said earlier, try to be first to the punch to push out new information. And, you have to balance what is truly correct and what might not be. And so it is a gray area, so it's all up for interpretation. But to your point, the regulations have cleared up a lot of what we need to know with QPP and made people more comfortable. So we're seeing more of like projects that we put on hold that were manufacturing driven. We did the cost segregation study. We waited for regulations. Now we have regulations. We can go in there and identify what's QPP eligible and get that additional deduction for these people that kind of, I would say, waited or put returns on hold.
So, Mike, you've been talking about a lot of big numbers. I mean, for some people, these are huge. So let's say I'm a business owner. I'm building a $10 million manufacturing plant. You mentioned earlier 20% personal property land improvements. That's $2 million. On the rest of it, you said, let's say 50% is manufacturing. That's another $4 million. So now I'm sitting with $6 million in deductions.
Mm-hmm.
As you're sitting with CPA firms, what are some of the questions that come up, whether it be related to passive activities or other things that need to be discussed up front with the taxpayer to determine if they can even access some of this? Or is it something they can just wait and not worry about and just keep their fingers crossed that it all works out?
Definitely not the last part. So, I mean, you never want to hope and pray when it comes to taxes. I think, one of the main pieces is making sure, people have this deduction. They're eligible for it. Whether or not they can use it is a bigger question. And so we need to really sit there with the CPA firm and ask, okay, are you actually active in the investment? Are you passive? If you are passive, what does the passive income situation look like? So that way the CPA firm that we're working alongside can confirm that element of it and say, okay, this deduction can be taken. Maybe not all of it, but the depreciation will roll into some of the future years that they could take. The other situation too is if it's what we call look-back studies or a building that was placed in service 2, 3, 4 years ago of whatever that current tax year is, understanding, okay, we have a depreciation schedule that we have to look at. Now we have a 3115, so there's a change in accounting method that needs to be filed in order to take that. But there's also situations where, you can't do that in back-to-back years. And so we need to understand the full picture of maybe they have an entity that has 3 buildings in it. And they'd had a 3115 done for one asset in 1 year, but they want to do it again the next year. So we have to work through those situations to make sure, can we do that? Or sometimes you need to just go amend the return, get it cleaned up, and move forward. So a lot of the situations we run across are just figuring out, okay, yes, you have income, but this deduction, it'll generate a nice size deduction that lowers your taxable income. It can carry forward, but we can't lose sight of information with CPA firms that they might have new clients that they onboard that have never heard of cost segregation, even though it's been around for a while. Mm-hmm. We can work alongside them and identify, look, they've owned these buildings for 5, 10 years, whatever that timeline might be. Let's go find and see if the deductions are there to pull them forward to offset their future taxes.
I want to take one thing you said. You mentioned the 3115 and how on cost seg studies you can kind of go retroactively and look at them. Now, we've also been talking about this new QPP for manufacturing plants. Do you think in a couple of years, let's say I have a manufacturing plant I placed in service in 2026 and I ignore the QPP or my CPA doesn't bring it to my attention? Do you think that's something in 2028 I notice it, I'm going to be able to file a 3115 and get a catch-up deduction?
Unfortunately, Dave, it doesn't work the same way. It's a current year election, can only be used in the same year that building is done and made on that same return. And so if you do want to do something like that, it's not eligible. And so the current year election prohibits you from doing that, so you have to take it on that return.
So, Mike, it's interesting, but it does show the importance of being upfront with the CPA firms and not putting some of these things on the back burner. I think combining that, and I know you deal with a lot of CPA firms, I know 2026, for example, it's going to be a critical year because not only do we have this, but you have some people that are starting to pull in some of those 174 on the R&D. Yeah. I know that's not what today's about, but I know combining that if they build a new manufacturing plant or have a change in their business, planning for when they're going to get all these deductions seems like it's going to be a lot of work for those CPA firms.
Oh, it is. I mean, you made a great point. I mean, we're talking manufacturing. Well, yes, there's all these incentives. To your point, you can grab all these deductions and make sure that you're taking them, but you can't utilize them all because you might have the 174 add back, so you're deducting all of that from your taxable income, and you say you bought a building, built a building, now you have an additional deductions that are coming online. So, I mean, now you're talking more around the world of NOL limitations in some situations for individual pass-throughs in those situations where they're limited on the ability of what they can actually deduct. And so that's the game, is you're working around the strategy not only on depreciation, that's one lane, but all of these things come together. And so it's a big puzzle that not only the CPA firm's a big piece of it, but we're also a big piece in it, identifying exactly what those deductions look like, model them out, push them over to the firm so they can work through some of those financial forecasts to make sure that it does make sense.
So, Mike, based on what you're saying, it sounds like this year is going to be, and really the next couple of years are going to be big tax planning years. And although sometimes with tax planning, we get all excited when we have big deductions. We forget that sometimes those deductions can get so large that it actually increases the amount of tax planning we have to do.
It's exactly right.
Well, Mike, I appreciate it. Sounds like there's a lot that you're going to be talking to CPA firms over the next couple of years about, and it's not going to be just a quick phone call. They're going to have you on the line and probably be talking to you. So I appreciate some of your insight here today, and hopefully people listening learned a little bit more about some of these depreciation changes with OB3. But as they go through, if anybody has any questions about whether it be the cost segregation, whether it be the new qualified production property, some things we didn't talk about today, like the phase out of 179D. Hopefully they know to reach out to you or somebody else at McGuire Sponsel, and we can get those questions answered.
That's exactly right.
Well, thank you for joining us today, Mike. It was good talking to you, and I appreciate your insight.
No, appreciate it, Dave. Thank you.